What's up, everybody? It's the Digital World Podcast, and we're back at it. 4.92, folks. Last time we made a video on Thursday, around 4.81, around there, and we've decided we're jumping up. And I want you to see how compressed it is right here. You see how it starts going, it widens and then it starts compressing, and now you have this compression here. Folks, I mean, this is like a rubber band waiting to just explode. And obviously this is it's a slow mover, right? Bonds move very slowly, but as can be seen here with 40 years worth of data, right? It's slow acting. But when it breaks this 5% threshold here, because it's been acting as resistance, but it keeps coming back and testing it, keeps coming back and testing it. And when it does, it's just gonna pop up. And whatever that event or catalyst is to make it go higher, I think it's worth watching. We have seen mortgage rates come down 6.58. It's a whole 20 basis points lower than what it has been since we've been covering this for a couple months. And so that has come down. However, we are expected to have a 25 basis point rate hike in September. Okay, the odds are at like 90 something percent. Um, but I think you need to be very careful, because let me show you something. We obviously have the dynamics. We've had inflation, the PPI and the CPI that came out late last week. And you saw that it came in harder than expected, way harder, right? And so we know there's inflation risks, but there's also economic risks of things going pretty south really quick. The state of the economy, right? You see the unemployment numbers. They're starting to, well, they're telling you about the revisions, but it, it'll keep on going until everything's ready and the plug is ready to be pulled. But there's no doubting that the markets are telling you, like, there is something on the horizon that's coming, and you better brace yourself, right? And usually when rate cuts begin to happen, it signals the beginning of the end. So, for me, I think that we've gone away from this bull market for the bond market, and we've now entered a bear market ever since July 2020 that marked the bottom, right? And now what we're going to see is yields, right? Go higher. And if you're an investor, right, this will, like, if you park your money in a treasury bond, note, or bill, you're gonna get higher returns, right? On the contrary, this means that it'd be higher borrowing cost that the government has to pay, hence the bear market. And I think there's this time period that we're entering is going to be very volatile. It's going to be an increasingly volatile um, uh, set of decades, if you will, right? Because all this takes years to play out. What I wanted to show you is this housing, right? Because this whole channel is surrounded on housing and the 30-year mortgage loan. So contract signings to buy a house hits the lowest level in 30 years. So you see what this is tracking. It's the pending home sale index. Contract signings, if this even loads. Anyways, it goes back to 2001, basically 1999. And it's the lowest it's been since the great financial crisis. So what does that tell you? And I don't know if this includes new and older homes, or if it's or how it classifies it, or maybe it's in counting all types of home signings. But folks, these are levels not seen since the great financial crisis, and we're even lower than then. So that tells you something. The lowest here was about 76. We're at 72. So I don't know if that tells you anything, but it shows you where we're at. 30, and this is where I want to go next. 30-year bond jumps to highest level in 40 years in Germany. 14 years, right? And they've had a lot more rate cuts than we've had. And what does that show? This is this is the exact same chart, just from a different view and from someone else. Here you see the rate cuts mean the 10-year yield goes higher versus lower as seen in Germany because the risk of inflation rises. The only thing Fed rate cuts will do is hurt savers. So my stance has been that we're going to see the 30-year bond jump higher. The rate cut, it's going to catch people off guard, and the opposite is going to happen. And so once that rate cut happens, we'll see, right? Because the same thing happened last year. Rate cut in October, November, and you saw the opposite happen. It caught people off guard. And here we see 511,000 new homes for sale in the U.S., the highest inventory since October 2007. Folks, this is what you need to look at. I know it's a simple chart and you can break it down 1,000 different ways, but this is what you need to be paying attention to. What's the direction this is headed? And if you look at this chart, dissect it in 5-year segments. 5 years is plenty of time to indicate if there's been a change in direction. And there has been. And I'm just waiting for this to keep climbing higher. And people will be caught off guard. And all of a sudden, borrowing rates for your mortgage loans are going to get more expensive. And the prices of those homes are going to come down. So as far as what you pay for the house is going to come down. Borrowing costs might be higher, right? Or it might level out, right? Like if price comes down and yield goes up, it might be pretty much the same. It just depends. But nevertheless, it provides a cheaper face value of the house. Instead of paying 400 and something thousand for the house, you might be paying 300,000, right? And so you see some markets like Florida, like Texas, certain metros that have come down drastically in price. You'll even see some homes, right? On the average, you'll see some parts like, oh, it's down 20% on average, or but some houses you'll see like, hey, they were worth 530,000 at its peak, and now they're like 280. And this isn't, I believe it was at Palm Beach, West Palm Beach, Florida. There's some instances that I've talked about in the past. So, 4.92, folks. Something in September, it might just send it to above 5, and I don't think we'll be going back below. It might retest it, but I think we're up for good once we make that jump. And you'll see it, and I'll be here, and we will discuss it. But I do believe this is where it's going higher. So, anyways, thank you for watching. Like and subscribe to the channel. Let me know your guys' thoughts. I'm curious to see what it's like in your guys' area. So, thank you for watching. Like and subscribe to the channel. It's the Digital World Podcast, and I'll see you in the next episode.